Your credit score controls whether you get approved for an apartment, a car loan, a credit card, even some jobs. It can decide the interest rate you pay on a mortgage for the next 30 years. And yet almost nobody actually sits down and explains how it works. Today, that changes. This is the complete beginner's guide to credit scores. What they are, what actually moves them, the myths that trip people up, and the one mistake that quietly keeps beginners stuck at zero. Let's start with why this actually matters in real life, because it's easy to think of a credit score as just an abstract number. It's not. A low credit score can mean paying thousands of dollars more in interest over the life of a car loan compared to someone with excellent credit. It can mean getting rejected for an apartment lease, even if you can clearly afford the rent. Some employers, especially in finance-related roles, even check credit as part of a background review. This number follows you into almost every major financial decision you'll make as an adult, which is exactly why it's worth understanding properly instead of guessing. So what actually is a credit score? It's a 3-digit number, ranging from 300 to 850, that represents how likely you are to repay borrowed money based on your financial history. Lenders use this number to quickly assess risk without having to manually review your entire financial life every time you apply for something. Here's a detail most people don't know. You don't have just one credit score. You actually have several. There are 3 major credit bureaus in the United States: Experian, Equifax, and TransUnion. Each one independently collects data about your credit accounts, and because they don't always receive identical information at the same time, your score can differ slightly between the 3. On top of that, the specific scoring model most lenders rely on is called a FICO score, developed by the Fair Isaac Corporation, which takes the raw data from those bureaus and converts it into the number lenders actually see. There's also a newer model called Vantage Score, which some services show you for free. The exact number might vary a little depending on which one you're looking at, but they're all measuring roughly the same underlying behavior. Now let's get into the part that actually matters most: the 5 factors that make up your score, and importantly, they are not weighted equally. Understanding this breakdown is the single most useful thing you'll learn in this video. Factor number 1 is payment history, and it accounts for 35% of your score, by far the largest single factor. This simply measures whether you pay your bills on time. It sounds almost too simple, but here's what catches people off guard. A single payment that's 30 days or more late can be reported to the bureaus and can knock your score down significantly, sometimes by 50 to 100 points depending on how strong your credit was beforehand. And that late payment can stay visible on your credit report for up to 7 years. This is exactly why setting up autopay on every account you have is one of the highest value things you can do. It removes human error from the equation entirely. Factor number 2 is credit utilization, worth 30%. This measures how much of your available credit you're actually using at any given time. If you have a credit card with a $1,000 limit and you're carrying a $300 balance, your utilization on that card is 30%. As a general guideline, staying under 30% keeps you in reasonably good shape, but if you want to push toward an excellent score, staying under 10% is noticeably better. A very common misconception here is that carrying a balance and paying interest somehow helps your score. It doesn't. Credit bureaus don't reward you for paying interest. You can have a perfect score while paying your statement balance in full every single month and never paying the credit card company a cent in interest. Factor number 3 is length of credit history, worth 15%. This looks at how long your credit accounts have existed, specifically the average age of all your accounts combined. This is precisely why financial advisors tell you never to close your oldest credit card, even one you barely use. Doing so removes it from the average age calculation and can actually cause your score to drop, not improve. Factor number 4 is credit mix, worth 10%. This factor looks at whether you have experience managing different types of credit. For example, a revolving account like a credit card alongside an installment account like a car loan or student loan. It's a relatively small factor, so this is not something to force. Taking out a loan purely to diversify your credit mix is rarely worth the cost of the loan itself. This tends to develop naturally as your financial life grows. Factor number 5 is new credit inquiries, also worth 10%. Every time you formally apply for a credit card or loan, the lender performs what's called a hard inquiry, and this can cause a small, temporary dip in your score, usually just a few points. The problem arises when someone applies for several credit products within a short window, because multiple inquiries stacked together signal higher risk to lenders. A good rule of thumb is to space out applications rather than applying for everything at once. Now let's clear up a few myths, because there's a lot of misinformation floating around about credit scores. Myth number 1, checking your own credit score hurts it. This is false. Checking your own score is called a soft inquiry, and it has zero impact on your score, no matter how often you check. Myth number 2, carrying a balance improves your score. As we covered, this is also false. Paying in full every month is not only fine, it's actually the ideal behavior. Myth number 3, closing a credit card automatically helps your score by reducing temptation to spend. In reality, closing a card can hurt your utilization ratio and shorten your average account age, both of which can lower your score rather than raise it. Myth number 4, you need to be in debt to have good credit. This one is completely backwards. You can build excellent credit using a credit card purely as a payment tool, paying it off in full every month, and never carrying a balance or paying interest at all. Now, the mistake, the one I see beginners make constantly. When someone has no credit history, the instinct is often to avoid credit entirely. No credit cards, no loans, nothing. It feels like the responsible, cautious choice. But it actually backfires in a very specific way. If you have zero credit history, you also have no credit score, because there's simply no data for the bureaus to calculate one from. This means landlords, lenders, and sometimes even employers have no reliable way to evaluate you, which can make approval for basic things like an apartment lease surprisingly difficult, sometimes more difficult than for someone with a small amount of well-managed debt. The fix is almost always the same for beginners. Apply for a secured credit card. With a secured card, you put down a refundable deposit, often somewhere between $200 and $500, and that deposit becomes your credit limit. You then use the card for small, predictable purchases, like gas or a recurring subscription, and pay the full balance every single month without exception. After roughly 6 to 12 months of this pattern, most people qualify to upgrade to a standard, unsecured credit card, with a real credit score already built in the process. Before we wrap up, here's how to actually check your score without paying anything. Most major banking apps now show you a free credit score directly in the app. Services like Credit Karma and Credit Sesame also provide free ongoing access, typically using the VantageScore model. You're also entitled to a completely free copy of your full credit report from each of the 3 bureaus once a year through the official site, annualcreditreport.com. This is worth doing at least once a year to check for errors, since mistakes on credit reports are more common than most people assume. So here's your action plan. First, check your credit score today using a free tool. Know your starting point. Second, if you have no credit history yet, apply for a secured credit card this week and start using it for small, recurring purchases. Third, set up autopay on every credit account you have, so a late payment never happens by accident. Fourth, keep your utilization under 30% at all times, ideally closer to 10%. And fifth, pull your full credit report once a year to check for errors you can dispute. That's the complete picture of how credit scores actually work. No myths, no guesswork, just the 5 factors that matter and exactly what to do about each one. In the next video, I'm walking you through the full roadmap from 0 credit all the way to a 700+ score, stage by stage, with realistic timelines. If this helped you finally understand your credit score, subscribe. New videos on credit and personal finance go up every week. And tell me in the comments, what's your credit score right now, or are you starting completely